So good evening, everyone. Today's lecture will be on gold investments. So remember, this is a series on financial planning, and we have been looking at different ways of investing the surplus money that we have. So we've looked at mutual funds as one way of investing. We've looked at equity as another way. In equity, we looked at fundamental analysis, at technical analysis, and now we will be looking at gold investments. So among the different asset classes in which you can invest, one of them is gold. So before you begin investing in gold, it's necessary that you understand some of the basics about gold investing and how you can invest in gold. Should you invest by actually physically buying gold, or are there other options available which offer you the same benefits without the risks? So I'll share my presentation with you, and we can take it from. So let's access. So India has an estimated 23,000 tons of physical gold. So we hold approximately 10% of the world's total gold inventory. This is one interesting fact. India is also the largest importer of gold, and we import between 700 and 800 tons of gold. And during COVID, that was the one time when gold imports had gone down to its all-time lows. And gold prices in that period was at among its highest in those days at 44,600 per 10 grams. Now, why do we buy gold? So one thing we should be clear is that we do buy gold. There is a lot of buying of gold by Indians. And as we know, one of the big reasons for that is that gold jewelry is something which a marriage is incomplete without. We have to have gold jewelry. And because of that, there is a large demand for gold. But when we speak in this particular unit, we are speaking more in terms of the best ways of buying gold for the purpose of investment. So we're not interested in getting designer jewelry. What we really want is a designer vehicle, an investment vehicle that can base itself on gold and provide us with the benefits of gold without actually exposing us to the risks that are involved. So firstly, it is a hedge against inflation. One of the big reasons is it's a hedge against inflation. The idea being that if you have gold with you, in times of inflation, it will be a buffer which will help you. That's number one. Second, of course, is that it's a store of value. Third is that it has instant liquidity. If you have gold, you want to convert it into cash, it's easy for you to convert it. You can take it to a jeweler and you can easily get it converted into cash. And it has low volatility as compared to equities. For example, equity with volatility in this context, speaking about the rise and fall in the prices of a particular commodity or a share. So, for example, when we speak about shares, what we have is when we speak about shares, what we see is that if you study the share prices, you'll see that it goes up, it goes down, it may stay stable. There's a lot of uncertainty. In the case of gold, if you look at the way the price moves, it is not as erratic as shares. So it seems to be much, much more stable. So if you're investing in gold, you know that you're not exposed to the risks of rising or dropping prices. That doesn't happen too often. And then it's an excellent diversification for your portfolio. So when we speak about portfolio here, we're talking about the financial instruments or the financial assets that you create during the course of investing. So when you invest, you may start with let's say an LIC policy or any insurance policy. You may then go for mutual funds, you may buy equity, you may buy real estate, number of options. You can do some of these things, but when you actually go for gold, you are going for a asset class which is different from the others, more stable than the others, and something which has always been stable. It is historically stable. So when we do this, we manage to enrich our portfolio of financial assets. So it's never good to be invested in just one thing. So when you have a number of these assets, it sort of helps. Then it's a global asset class. So gold is something which has value across the world. It's not like, for example, if you do any investing in if you do invest in assets within the country, what you'll find is that you are essentially investing in things which are priced in Indian currency. When we invest in gold, it has a value across the world. So that's why it's referred to as a global asset class. Now, if you look at gold prices in India, what you will see here is that, let's say that the base year is 1974 in this particular graph. And if we go up till 2020, what we find here is that it has risen from 0 to 4,501. This is per gram of gold. So it's almost 45,000 for 10 grams. This has been the growth from 1974 onwards. And as you can see, that it has been relatively steady up till around 2009, after which it began to rise. And if you recall, 2008 was the year of the Great Recession. There were problems in the financial markets. And as a result of that, people felt safer when invested in gold. And when they did that, gold demand increased, gold prices increased. And you see the spike from 2010 all the way to 2013, after which you begin to see a slight dip till around 2016, 17. And then you have this strong rise again after 2017. So what you're seeing basically is that when people tend to feel in danger in the stock markets, when they feel the risk is too high, they tend to invest in gold. What have been the gold returns during this period? If you look at this, look at the price of gold here in INR. What we've done here is that we have basically focused on the years 2001 till 2020. Just to give you this is like, it's zooming in on the earlier graph that I had shown you in the last slide. And this gives you an idea about what has happened in this particular century. Like 2001 onwards, you see you can see the same pattern. It's pretty steady. From 2008, it begins to climb, climbs up to 2013. Then there's a slight dip. There are highs and lows, but broadly speaking, it's in the same 2,500 band right up to 2017, after which it begins to rise again, and it reaches this 4,500.97 on September 22nd, 2020. So these are the different phases in the way the gold prices have moved. So what this basically tells you is, let's just reiterate that point, that when people feel shaky in the stock markets, they tend to move towards gold. And that's why investments in gold are considered to be counter-cyclical. So it goes against the cycle in which the economy is. In this period, if we live in which federal of you basically handling monetary policy, what we see is that this period here is a period of easy liquidity by the Fed. So they've allowed liquidity to be lots of dollars to be pumped into the economy. Some of that is finding its way. Then you have this global stock market crash of 2008 that is leading to the spike in the gold prices. And then you have a gold stock market boom since 2011-12, because of which so here we've zoomed in on the period from 2011 to 2020 to give you a better idea of the way the gold prices have actually moved. And you will basically, if you compare this with the other two slides, the previous two slides, you will get an idea of exactly what is happening with gold prices. And as we've seen in the last slide, periods when there's a stock market boom, you see less of investment in gold. And when people feel threatened in the stock markets, you see the gold prices rise. So these are the returns which gold has given over in this period. So in these years, 2011-12, all the way to say 2013, you have all double-digit returns. 11, it's 23.7. If you come to 2012, this period, it's 31%. Steady, a huge increase in that year. In 2013, it's 10.3%. Then it drops to minus 18.7%, minus 5.9%. But thereafter, you can see it's all green rectangles all the way. So it's increased and it's given a fairly good return after that. So you can see that there is a certain steadiness in the way gold moves, and it is often worth it to have gold in your portfolio. If you compare gold with the Sensex, the golden line here representing gold and the dark gray line is the Sensex. If you look at this, see, if you go from May 2000 till May 2020, what you see is that gold gives you a fairly steady return all throughout, and it ends up at higher than the Sensex in May 20. The 20-year returns for gold is 12.54%. And for the Sensex, it is 10.29%. So the value of 1 lakh invested 20 years ago becomes, for gold, it becomes 10 lakhs 61,411. And the value of the same 1 lakh invested in stocks, in let's say the same stocks on the basis of which the Sensex is formed, you would have got 7,08,937. And generally what we think is that gold is something which doesn't give you a good return. It is stable, but it's very low. But here I'm again emphasizing the point which I've made all throughout, whenever we've spoken about investment, that when you basically stay invested for a long period of time in a good asset, the chances are that you will make a lot of money without the hassle of, or let's say this continuous buying, selling, or the tension which comes with investing in volatile assets. So that is the advantage when you invest in a asset class like gold, and you stay invested. So the point is this, that you stay invested. Most of us don't have the time or the expertise to actually get into solid investing, where, aggressive investing, where you follow the share markets and you try to make the best out of the volatility of different stocks. That is always a risky game. Statistically, more people lose than gain when they go for aggressive trading in the stock market. So what I think, you see, the audience I'm addressing here, you are people who already have a job, or you're working towards getting a job. So when you actually invest in something like gold, it frees up time for you to focus on the things that matter to you, instead of focusing on investments like, instead of spending your time on and with a lot of tension by investing in the stock markets. If you look at gold versus inflation, the rate of inflation which has happened every year and gold, so what you can see is that from May 2011, you'll see that after a period of time, it has moved more or less in tandem with inflation. That means with inflation, the price of gold has also managed to stay more or less at the same rate as inflation. And that's why we say that it acts as a hedge against inflation. So as prices rise, gold prices also rise. So in terms of purchasing power, it's the same. If you look at it in terms of the actual figures, in March 2011, the price of gold was about rupees 17,000 per gram. The consumer price index was about 85. In March 2020, gold was at rupees 32,000 and the CPI was 145. So as the CPI rose, so did the price of gold. You can have a look at this to get an idea about the way the gold prices moved in this period between June 19 and May 20. Now, how are gold prices determined? So we've established that investing in gold can be profitable. Investing in gold acts as a hedge against inflation. Investing in gold gives you a diversification in your asset portfolio. So there are a number of good things that happen when you actually invest in gold. That's one. Now, how are the gold, like prices determined? So one is, of course, by the global price of gold in US dollars. So that price is applicable across the world. Even today, if you were to go to any jeweler shop and you want to sell gold, the jeweler will find out what the price of gold is today. And that price is the same. You go to any place, anywhere in India, in fact, anywhere in the world, that price is going to be the same. And the other fact which actually has an impact is the US dollar and Indian rupee exchange rates. So basically, the gold is quoted in US dollars, but if the exchange rate, see the rate, how many dollars, how many rupees make a dollar, that rate. So when we say exchange rate, if I have $1, if I go to a bank and exchange that for Indian rupees, how many rupees will I get? So that exchange rate is something which will also determine the price of gold. Since the gold is priced in dollars, so if you want to know it in rupees, you have to apply the exchange rate. And that exchange rate can sometimes go up, it can go down a little. So depending on where that exchange rate is, that will determine the exact price of the gold. The other factor is the gold price itself, the US dollar gold price, that is affected by the global supply demand of gold. So global supply of gold is approximately 2,500 tons per annum. This is matched by demand of 2,500 tons per annum. So the demand and supply is equal. Now, out of this, 55% is for jewelry, 33% is for investment, and 12% is for technological manufacturing. So this is how, so 55% goes for jewelry, 33% for investment. I think if I were to ask you to, had I asked you to guess what takes up more gold, jewelry or investment, I'm sure all of you would have instinctively said that, especially because we are all Indians, you instinctively have said that, yes, it is in jewelry, which actually is much, much more, let's say it consumes more gold than investments. Then the liquidity policies of the large economies, the US, the European Union, Japan, and China. During the period when I made this presentation, all countries had opened up the liquidity due to COVID-19. Okay. Global economic conditions. These are the different factors which basically affect the rate of gold. Now, if we look at our own GDP growth, now, like I said, one of the factors that affects the price of gold is the exchange rate, between the US dollar and the Indian rupee. If you look at this, the US dollar Indian rupee conversion rate, this depends on the relative strengths of the US economy and Indian economy. So essentially, people want rupees when they want to buy Indian goods. That's the only time when somebody will want a rupee. Similarly, we want dollars when we want to buy something which is priced in dollars. So basically, if your economy is strong, if you have exports to make and people are demanding rupees, then the price of the rupees, if there is a demand for rupees, the price of the rupees vis-a-vis other foreign currency would tend to go up. If there is less demand, and if there is a higher demand, let's say for US dollars, then the chances are that the price of US dollar in Indian rupees is going to go up. So that's basically what happens. The inflation rate reduces the purchasing capacity of a rupee. Similarly, the inflation rates in the US reduce the purchasing capacity of the dollar. But since the Indian inflation rate tends to be higher than the US inflation rate, there is a certain annual rupee devaluation vis-a-vis the US dollar. So every year, if you were to look at the prices, what you'll see is that the dollar gets a little more expensive in terms of rupees year after year. That is because the purchasing capacity of the Indian rupee is going down as compared with that of the US dollar. So here is an example. So in 2015, the India inflation rate was 5.88%. The US inflation rate was 0.7. So this basically means that, let's say that in 2015, if you had 100 rupees at the beginning of the year, it would take you 105.88 rupees to purchase the same amount of commodities that you could have purchased with 100 rupees. But in the US, if you had $100, it would then take you only just short of $101 to buy the same amount of commodities that you could have bought with $100 there. So what that basically indicates that the rupee is depreciating faster. So the inflation gap here is 5.18. This is the loss in purchasing power for the Indian rupee vis-a-vis the dollar in 2015. In 2016, it comes down to 2.87. In 2017, it's 0.39. 2018, it's 2.95. 2019, it's 5.36. So on an average, the 3.35 is the inflation gap between the US and India. That means every year, since our inflation rates are higher, the exchange rate is going to go against us, which also means that the rate of gold will also be the basic cost of gold will be higher, since it is priced initially in US dollars and then tends to get exchanged into Indian rupees. So just to repeat that, the US dollar Indian rupee conversion rate depends on the relative strengths of the US economy and Indian economy. The annual rupee devaluation vis-a-vis the US dollar, this is basically based on the Indian inflation rate minus the US inflation rate, as we saw in the last slide. And inflation in the US last 5 years was 1.82%. In India, it was 5.17%. The annual rupee devaluation vis-a-vis US dollar is 3.35% over the past 5 years. So that is, again, something just to give you an idea about how gold prices are decided. That you must understand that apart from the demand and supply factor, there is also this critical factor, the exchange rate between the US dollar and the Indian rupee. This chart here will also give you an idea about the 5-year the exchange rates between the US dollar and the Indian rupee. And this is between 2015 and 2020. And you can see that the lowest point, or let's say the best exchange rate that the rupee had with the US dollar was 63.33, and the highest was 77.38. So rupees 66.16 on 27th September 2015, rupees 73.50 on 23rd September 2020. So basically 5.87%. If you look at Nifty, which is another one of our stock indices, one is Z6, the other is Nifty. So if you look at this over the past 10 years, So gold has outperformed Nifty over a 10-year period. So this is the point I was making a little earlier also, that when you invest in gold, despite the fact that it tends to be stable and you don't associate it with high returns, over long periods of time, it tends to give you a better return than the stock markets, without the tension that stock market investing quite often involves. So how do you invest in gold in India? Physical gold, jewelry is one, which I think all of us are very well aware of. The other, of course, is that you buy a gold bar or a gold coin. Then you have the jewelers' investment schemes, where you keep on paying for years and at the end can redeem your investment for gold at a prefixed price. So these schemes are in vogue even today. So if you go to a jeweler, you fix the price. He asks you to basically keep paying a certain amount. And then when the time comes for you to redeem your investment, you go there and you buy something at that prefixed price. So if gold prices have gone up in the interim, you get that advantage. So that is the big advantage that you get when you go for this. And then there are gold exchange traded funds on the stock exchange. And this is basically based on real gold. This we'll discuss. Then there's the sovereign gold bond scheme. This is a scheme which the government comes out from time to time. So this is also a way of investing. Then, of course, there was this gold monetization scheme for households to hand over the gold available to government. It is not an investment scheme. So essentially what you have is you either go for jewelry, you go for actual physical purchases of gold bars or coins, or you go for the gold exchange traded fund, or you go for a sovereign gold bond scheme. These are the options that you basically have. Now, when we go for gold exchange traded funds, you get the flexibility of stock investment. So essentially what happens is that you can basically treat it like a stock. Buying an ETF is very similar to buying a stock. So it trades in the National Stock Exchange like company stock. It can be bought and sold continuously at market prices. So the feel of the entire transaction is like the same feel you have when you actually buy or sell stock. So gold ETFs are passive investment instruments that are based on gold prices and invest in gold bullion. So the money which they get from you, it is invested in gold. Because of its direct gold pricing, there is complete transparency on the holdings of an ETF. Further, due to its unique structure and creation mechanism, the ETFs have very low expenses as compared with physical gold investments. So see, there's no security risk here. You getting a bank locker, paying for the locker, keeping the gold there, or taking the risk of keeping the gold at home. All that doesn't happen here. So that's one advantage. And which are the different gold ETFs which are available? So you have Axis Mutual Fund. The name is Axis Gold ETF. Symbol is Axis Gold. And it was launched in November 2010. So you can buy you can buy units here, no issues at all. Then Birla Sun Life Mutual Fund, which has a Birla Sun Life Gold ETF. Then you have a Canara Robeco Gold ETF, HDFC Gold Exchange Traded Fund, ICICI Prudential Gold Exchange Traded Fund, the IDBI Gold Exchange Traded Fund, the Kotak Gold Exchange Traded Fund, the Quantum Gold Fund, the Reliance Gold Exchange Traded Fund, the Religare Gold Exchange Traded Fund, and the SBI Gold Exchange Traded Scheme. All these schemes have come up basically after 2007, the earliest being the Reliance Gold Exchange Traded Scheme. But as you can see, most of them have come up in the years 2010 and 11. So these, if you invest here, you are basically investing in gold. because whatever you invest in these particular instruments, they are, that entire money is taken and it is invested in gold at the market price of gold on the day of the investment. When you pull it out, it will be at the market price of gold on that day. So there is complete transparency. And since you don't require a great fund manager for any buy sell transactions here, the expenses are low. And remember that whenever you go for a mutual fund or any fund of this sort, the expense ratio is something which cuts into the returns that you get. So if the expense ratio is low, that is an advantage for you. So what are the advantages? Investing and exit is convenient. Like I said, it's as convenient as doing it on the stock market. There is transparency in pricing because it is based on internationally declared gold prices. So that's a big advantage. It is affordable, as you can buy in units representing 1 gram of gold. That's another. So like we were saying, 1 gram of gold means about little less than 5,000 rupees. So if you're it's possible for you to buy as per your capacity, but it goes as low as 5,000. There are no issues of purity. So when you're buying physical gold, one of the big things that you are concerned with is this gold pure? You begin thinking in terms of how many carat gold is this? And then you're worried about whether whatever is being told to you about the purity, that is correct or not. You have no way of knowing. You believe the person who you buy it from. So all that hassle is not there in the case of these ETFs. There are no storage issues. Like I said, no bank locker required, no locker rentals to be made to the bank. This is just it's a digital transaction maintained digitally. Then it is tax efficient in the sense that there is no sales tax or wealth tax on gold ETFs. So if you were to actually buy gold, there would be a GST involved. Here, nothing of that sort. To continue with the advantages, the purity of the gold is guaranteed and each unit is backed by physical gold of high purity. First benefit, transparent and real-time gold prices. So when you enter, you are entering at the price of gold on that day. When you exit, you are exiting at the price of gold on that particular day. Then it's listed and traded on a stock exchange. That basically means that if you have a trading account with, let's say, any securities firm, like let's say Kotak Securities or Religare or any of these, it will be easy for you to make the transaction. You can do it as easily as, on your mobile or on your laptop. Very easy to do this. And then it's tax efficient, as the income earned from them is treated as a long-term capital gain. So you pay lower taxes there. No wealth tax, no security transaction tax, no GST. No fear of theft, safe and secure as units held in DMAT. One also saves on safe deposit locker charges, the point I was making earlier. And ETFs are accepted as collateral for loans. If you need to actually give security to a bank for a loan that you want to take, so the ETF units that you have, that will be accepted by the bank. So essentially, you are investing in gold without any of the hassles of understanding whether it's pure or not, no storage issues, no tax issues. So it's an excellent way of diversifying your portfolio. And of course, there's no entry or exit load, something which happens in the case of, let's say, equity mutual funds or debt mutual funds. It's quite often there is a certain load which is attached to it. That means a certain charge that is taken from you when you make the investment, a certain charge that is levied when you exit. Prices as on 9/9/22, HDFC mutual fund Gold Exchange Traded Fund Limited. Look at this. This is a screenshot taken from the relevant website. 44.83 was the rate at which this is being sold. Basically, if you were to bring it up to gram, it will be 4,483. Axis Gold ETF fund was 43.85. SBI mutual fund was 44.82. And then you have the CRISIL ranking for this, that is there. In this particular case, the rank is not available for the fund. Here you have the, the way the prices have moved from the beginning till the end of the day. This is the low point, 44.71. The high point here, which is 44.95. You have the 52 weeks range, 39 to 49, 70. And then you have the volumes. So essentially what I'm telling you is it's as easy as this. These figures are all available. It's easy to do this. The other way to go for an investment is that when the government comes out with a sovereign gold bond scheme, you can invest in that. Now, in this particular case, you have, this is basically a screenshot of an advertisement brought out by ICICI Bank, where it says that earn 2.5% per annum on investment value, special discount of rupees 50 per gram on online investment in sovereign gold. And see, it makes the same point. Investing in gold is much more easy and convenient now. With the Government of India's sovereign gold bond scheme, you can earn the assured interest rate, eliminating risk and cost of storage. So attractive interest with asset appreciation opportunity. So you get 2.5%. Over and above this, you will get, if gold prices rise between the time you invested and the time you exit, you will get that capital appreciation also. The redemption is linked to the gold price. So as we've seen, gold prices generally tend to rise. So as they rise, you will get the capital appreciation also. That is the extra amount that you'll get because of the rise in price. Apart from that, you're also getting this 2.5% interest. Elimination of risk and cost of storage, and it's exempt from capital gains tax if held till maturity. So as you can see, this is also one good way of investing. One thing to remember here is that you are locked into the scheme for the duration of the scheme. So you pay rupees, you get a gold bond in digital form under the scheme. The bonds are issued and backed by the government. The value of the bond is equivalent to 1, 5, 10, 50, and 100 grams of gold. So depending on your capacity, you would go for the appropriate bond. Price of 1 gram of gold for an online investor for this scheme was rupees 4,736. An individual can buy up to 4 kgs of gold in terms of bonds. The bonds will carry a rate of interest 2.5% in the current scheme. The bonds will be for 8 years with exits possible in the 5th, 6th, 7th year as well. So basically, you're locked into the scheme for 5 years. After that, you will be able to exit in the 5th year, in the 6th year, in the 7th year as well. So it's very similar to a closed-ended mutual fund. At the end of the tenure, that is, let's say you're exiting after 8 years, you will be able to visit a post office or bank, redeem the bonds for the price of gold on the day you redeem. So as we've seen, gold prices appreciate over long periods of time. Over an 8-year period of time, gold prices are going to see an appreciation. And you're getting this 2.5% per annum interest. Apart from that, you're also getting the benefit of the appreciation in the gold price. So this is again something, what you're losing is the liquidity, in the sense that it is not possible for you to sell the bond back or get it redeemed before 5 years. But like we said, these things can also be used as secure collateral for loans. So you can submit the bonds as a security, and against that, you will be able to get the amount of loan that you want. So this is again another very good way of investing. So we have exchange traded funds, we have this gold bond scheme, and bonds will be tradable on a stock or bond exchange. So this will again give you a certain amount of liquidity if you want to go this route. So know your customer norms will apply. That means you will have to submit proof of identity and address. So mostly these days, your Aadhaar card should be sufficient. Above 50,000, you have to give proof. Capital gains will be like gold itself. Whatever the capital gains are on gold, the same capital gains will apply for this. 3 years and above is long-term capital gains with indexation if you transfer the bond before maturity. Say selling on a stock exchange, there is a capital gain thing, but indexation basically means it will set off the inflation which has taken place in between. That will be taken into account. So there is zero tax if you hold to maturity, but interest is taxable. You only get rupees on redemption, not gold. That is just something which you should recall. The investment is made in rupees, the investment is withdrawn in rupees. So essentially, this was a short, let's say, exposure to investing in gold. And the purpose, like I said, was that this will help you to diversify your investment. So go have a look at this slide, at this presentation, and then when we meet on next Saturday, we can discuss this in some more detail. We can look at the actual performance of some of these ETFs, live performances, which will help us to, you'll get a better idea of how it works. And we can then move on to the next part, which the next asset class which we'll be taking up will be real estate. So like I said, that we are looking at different ways of investing. The first thing we looked at was insurance. We looked at mutual funds. We looked at equity. Now we've seen gold. And then now the next and last one will be real estate. So these are the different options which you have. Hopefully, with a bit of interaction that we've been having, it will be possible for you to get a better idea about these different asset classes and then make an informed investment. So thank you for listening to this, and let's meet and next Saturday and discuss this further. Thank you.